All right, I'm trying this again. I keep messing things up. I keep forgetting to share my screen, and so I'm remaking this video. So let me share my screen. Sorry about that. And I went ahead and deleted everything that I've done except for basically the Gibbon. So Georgia Atlantic is leasing from IC Leasing on June 30th. And so there are semi-annual payments of $562,907. The lease term is 3 years, but it's semi-annual. So there will be 6 payments in total, with our first payment beginning on June 30th. Now, June 30th is the date that we lease the building. So it's at the beginning. Our rate is 10%, and then it said depreciation would be on a straight line basis. The fair value of the warehouse is $3 million. And so the first thing I needed to find out, the first question was, what's the present value of the minimum lease payments? So I would come up here to find the present value. My rate is 10%. Now, they said that that rate is the same as the borrowing rate, the implicit interest rate or whatever. So again, you would use the lesser of the two if 2 were given. But that 10% needs to be divided by 2 because the payments are semi-annual for a total of 6 payments. My payments are $562,907. And since the first payment happens at the beginning, this is an annuity due, so I'm going to put a 1 for type. So I'll hit OK, and it looks like the present value of the minimum lease payments is right about $3 million. Like if we round to the nearest dollar, we're at exactly $3 million. So that's the fair value of the warehouse. And so those are crappy payments, man. Can you imagine paying $3 million over 3 years and then giving the building back? Like, buildings should have a useful life well more than 3 years. If you're going to pay $3 million for a $3 million building over 3 years, you should get to keep it. But apparently these people aren't very smart, and they said, okay. So let's look at our criteria. Number 1, does the leased asset transfer to the lessee at the end? And they did not say that happened, so I would say no. Is there a BPO? No. This is a building. They're not going to let you keep it at the end. The next one is the 75% rule. And so is the lease term greater than 75% of the useful life of the asset? I don't have to type these out every time. I'm doing this because every time I say these criteria, they'll like solidify in your mind a little bit. So they didn't tell us the fair value or the useful life of the asset, but I do know literally that buildings useful life for tax purposes is anywhere, it depends on what you're doing with the building. Like if people live in it, it's 25-year property, but if not, and this is a warehouse, so my guess is people don't live there, not purposefully, it's a 39-year asset. So the lease term is 3 years. So is that greater than 75% of 39? And say, no, it's definitely not. So 75% of 39, a fourth of 40 is 10. So 3 years is definitely not greater. And then we have our 90% rule, which is the present value of the minimum lease payments greater than 90% of fair value? And the answer here is definitely yes, because the present value of the minimum lease payments is $3 million. So 90% of the fair value is $3 million. So the answer here would be it's actually 100%. So yes. Okay, so I did that. I'm not even sure why I did that because I knew it's a capital lease because it's kind of what it says in the margin or whatever. And so I just knew it was. But I like to go through those criteria. So it says, what amounts related to the lease would we report on our balance sheet at the end of 12/31/18? So on the balance sheet, I'm going to have leased asset and leased equipment, right? The leased asset for leased equipment and lease payable. So on 6/30/18, I would do this journal entry. I would debit lease equipment and credit lease payable for the present value of the minimum lease payments. So I'd like to do it for exactly $3 million, but I want my table to work out right. So I'm going to actually use that number. So I'm going to go ahead and I'm going to build my table. So my table is going to have a payment and interest and reduction in principal and an outstanding balance. And I'm going to start this table with 2,999,999,999,72. So my first payment is going to happen on 6/30 of 18. My next payment will be 12/31/18, and then 6/30 of 19, and 12/31 of 19. That's not what I wanted. And I need 4 more of those. There we go. Okay. So my payments are, they were given 562,907. So those will be my payments. My first payment, no interest. Because why? Why no interest? Because it's at the beginning, right? So immediately before we even leave, we write a check for 562,907 when we take possession of the leased property. So no interest yet. So we're going to take that number off of the 3 million-ish. The next time though, we do have interest. I need that rate, which was, oh, it was 10%, but it's semi-annual. So I'm going to take it times half. So reduce there, reduce there. I'm going to go back and do that again. I kind of did it fast. My payments stay constant over the lease term, the present value of the minimum lease payments. Those are equal lease payments. My interest is I equals PRT. So click on the outstanding balance times the rate times the time. The rate is 10%. The time is half a year, 6/12, whatever you want to put. So my reduction in principal is the difference between the two. So how much goes to principal? And then it whittles away from the outstanding balance. And then we should be able to skinny plus down. Ah, something went terribly wrong. How many payments do we have? 2, 3, 4, 5, 6. Oh, this was only 6 years, not, or 6 payments, not more than that. So this is a 3-year term. So I only need 3 years of payments. So these 2 rows are not necessary. Aha. Okay, so I hit 0 at the end. Okay, so you guys would have stopped me had you been here, but you were not here. So I went ahead and kept going. I knew something was wrong immediately because all these red numbers started appearing, which is normally a bad sign. I also know that my lease table always ends at 0. So my amortization tables always end at 0. So I just had a year extra of payments, and so I don't need to do that. So the question is, what amounts related to the lease would we report on our balance sheet? So number 2, what amounts would we report related to the balance sheet? So related to this lease. So we would have lease equipment and lease payable. And by the way, wouldn't I need to do, they didn't ask me to do any journal entries. Okay, but I want to go ahead and do those journal entries because I want to see what my balances are. So because I don't want to forget to do depreciation. I don't really know if I would have done depreciation normally. So I don't really think that like they asked me to do depreciation, but I'm going to go ahead and do it anyway. So let's go back over here. Okay, so let's do the journal entry on 6/30 of 18. I already did the one to establish the lease equipment and lease payable. On 6/30/18, I would make my first payment. So I would debit lease payable and credit cash. And that's for 562,907. And then on 12/31/18, I'm going to make another payment. So I'll do lease payable, interest expense, cash. On that second payment, again, I'm paying 562,907, but the portion that's interest is 121,857.64. The portion that's principal is here. So if we want to know what amounts show, and then I also need my depreciation entry. I keep wanting to forget it. So what I'm going to do is I'm going to take the value of the asset. Now, we talked about how this is probably like a 39-year asset, but we only have possession of the asset for 3 years, and we get to record the depreciation. So we are going to have to record that over the 3-year period, not over 39 years, because we don't get to keep it for 39 years. So what I'm going to do is I'm going to take that amount, and I'm going to divide it by 3 years. But we only had it for a half a year this year. So if we bought the asset, if we would have acquired this lease on January 1, then I would do a full year worth, which would be $1 million. So in this case, it's only from 6/30/18 to 12/31/18, so that's a half a year. So that's why, like in the problem, it said to round it to the nearest dollar. But if you do that, you're not going to get your table to work out perfectly. Because had we started this table at 3 million, which is what they wanted us to do, then we would have had 35 cents left at the bottom, and that really upsets me. So that's why I went ahead and started the table at the present value of the minimum lease payments, because I'm that OCD. You knew that about me. Let's go ahead and fix this. I can't believe I've gone this long without getting rid of those dollar signs or giving myself some decimals. There we go. That looks a little bit better. Okay, so for lease equipment and lease payable, that's what would show up on the balance sheet. So for lease equipment, I'm going to go ahead and just drag this one over here. So for lease equipment, I would show the amount of the equipment, which was originally I recorded $2,999,999.72, and then I would say less accumulated depreciation to get the book value of the equipment. The accumulated is $499,999.95. So the book value of the equipment would be that number. Again, if you rounded it to the nearest dollar, it's 2.5 million. So the $3 million asset is 1/6 used up because it's 6 payments and we've only used it for half a year so far. So, and then lease payable, the beginning balance in lease payable, if we were to just draw a lease payable T account, because sometimes it's good to do that. So let's do that. My children are doing homework like good kids. It's a good day. Okay, so I started lease payable with $2,999,999, and then I reduced it by that number, and I reduced it by that number. So my balance in lease payable at the end is $1,996,040.36. Now, there was an easier way to find that number, but I really wanted to show my work on literally how that worked, because they didn't even ask me to do these journal entries. I did them because I wanted to find the depreciation and I like to just practice the entries. But that 1996 is right here. So we could have just picked up that number instead. So, because that's the balance in lease payable at the end. And then my equipment is at its original cost less the accumulated. And then the third question said, what is the amount related to the lease on the income statement? So income statement, if we just look through these, asset, liability, liability, asset, liability, here's one. So the interest expense of 121. And the depreciation expense of 500,000. So those are the two numbers on the income statement that would relate to our lease. So that's it for exercise 15.3. But 15.4 is the exact same question, except for it wants to know, so it's the exact same question. It wants to know what amounts would relate to the lease on the balance sheet of IC leasing. So on June 30th, 18, Georgia Atlantic leased a warehouse from IC. The lease agreement calls for semi-annual payments of $562 over the 3-year term. Georgia Atlantic's incremental borrowing rate is 10%. What amounts relating to the lease would be on IC's balance sheet on 12/31/18? So for exercise 15.4, we are looking at this from the other side, the lessor. Okay, so let's go ahead and let's just do the journal entries related to the lease from the lessor side. So what they would do on 6/30/18, they said it's a sales type lease because they actually built it. So I would need to know, did they say sales type? Yeah. don't know what it costs to build it in the first place. And so the only thing I really can do here is lease receivable and the leased asset left the building. So the lease building or lease equipment or whatever you want to call it, we usually call it equipment, even though in this case it wasn't equipment. So officially we should probably have put it building here and building all the way through, but it's okay. It doesn't matter. Same concept. So we'll do lease receivable and lease equipment. And over the lease term, we are going to receive a total of $2,999,999. Okay. On 6/30 of 18, we're going to receive our first payment. So we're going to receive cash. That's not how you spell receivable. I just won't spell it. So our amount of each payment that we're going to receive is $562,907. And so on 12/31/18, we're going to receive the next lease payment. So we'll do cash, lease receivable, and interest revenue. So remember that when you're making the payments, it's interest expense, but in this case, we're receiving the payments. So when we receive cash, it's this much. The portion that goes to the principal would be that number, and the portion that is interest is that number. So I'm able to use the same table, and we do not have to record the depreciation because only one person records the depreciation. So only one person records the depreciation, and that is the person, if it's a capital lease, that owns it. And so the capital lease person is the other person. So no depreciation. So the question just wanted to know what amounts would be on the balance sheet. So out of all of these, all we're doing is looking at these journal entries. So number one, what amounts go on the balance sheet? And so we would use lease receivable. And the balance in lease receivable looks like the 299 number minus the 562 number minus the 441 number. So if we look, lease receivable, and lease receivable. Now my assumption is that this lease equipment, when it left the building, like it left us, like it would have been on there before and now we're removing it. So this would be like the sale of the asset. And this cash would be just included in our cash account. So really, I'm just going to use lease receivable. And then what amount goes on the income statement? And that would be the interest revenue. All right, so that's it for exercise 15.4. I knew it was super quick, so I just tagged it onto the end of exercise 15.3 because you kind of probably worked on those before together. And so basically exercise 15.5 is going to be another one of those. So this should really help you to get exercise 15.5 worked out. So let's stop our share. Nice to see you guys. Thank you very much.